Welcome to this explainer. Today, we are diving straight into Finova's highly anticipated guide, How to Start Investing in 2026. Look, even if you follow financial news closely, it's super easy to glance at the current market and think, man, I need a massive stockpile of cash just to get started. But as this guide brilliantly points out, that is a completely damaging misconception. So let's explore exactly how Noor's framework helps you build wealth step by step, no matter what your starting balance looks like.
Okay, let's dive into this. The guide immediately tackles the absolute biggest roadblock out there, waiting until you have enough money. It is incredibly tempting to just sit on the sidelines waiting for some big windfall or a promotion, right? But the data here reveals a really critical truth. Your most valuable asset actually isn't capital, it's time. Time in the market outweighs timing the market literally every single time.
So here's the reassuring step-by-step roadmap the guide lays out for us to lower any anxiety and build up your knowledge today. We'll start with what investing actually is, cover the power of time, discuss building your financial foundation, explore where to invest, highlight mistakes you definitely want to avoid, and finally, wrap up with a winning strategy.
Kicking things off with Section 1, what is investing? Or, simply put, making your money work.
Now, what's really interesting about this is how it fights our natural instincts. Intuitively, we kind of like to hoard, right? Imagine stuffing your cash under a mattress. A year later, it's the exact same amount, though, you might have a slightly lumpier bed. Compare that to putting your money into a business or a fund. Suddenly, your money has an actual job. It goes to work, generating potential returns, even while you sleep. Because at its core, investing is really just putting your money into assets that can increase in value over the long term. Now, are there guarantees? Absolutely not. But historically, shifting your mindset from passively saving to actively growing by acquiring these appreciating assets remains one of the absolute best ways to build long-term wealth. I mean, to put it into perspective, historically the S&P 500 has averaged around a 10% annual return over the long haul. That's the exact wealth-building engine we want to tap into.
Moving on to our second foundational pillar, Section 2, the power of time and exactly why starting right now matters so much. If there is one single core takeaway from Noor's guide you remember, let it be this. You don't have to invest thousands of dollars to make a real difference. Early, small investments grow massive over time. You don't need a giant lump sum sitting around. Actually, small, consistent contributions absolutely crush delayed, larger investments, all thanks to a very specific kind of mathematical magic.
And this brilliantly illustrates exactly what that magic is: compound growth. It's a process where your initial investment earnings begin earning their own returns over time. Think of it like a giant snowball rolling down a hill, picking up mass faster and faster. Your money earns money, and then those new earnings, they go straight to work too. It's a phenomenal cycle that turns modest monthly habits into major portfolios. $100 a month can literally turn into hundreds of thousands of dollars over a few decades, all because you're letting time do its thing.
Which is exactly why experienced investors always come back to this famous piece of wisdom. The best time to start was years ago, and the second best time is today. Regret doesn't compound, right? Only capital does. So stop worrying about what you didn't do in the past, because today is your new starting line.
That brings us to Section 3, building your financial foundation. Let's talk about what to do before you invest.
The guide outlines 3 absolutely non-negotiable prerequisites to set yourself up for a stress-free journey. First, build an emergency fund. You want to make sure a flat tire doesn't force you to liquidate your brand new portfolio in a panic. Second, pay off high-interest debt, mostly because credit card interest will almost always outpace any market gains you make. And third, only invest money you won't need in the near future. If you're going to need that cash for rent next month, it stays in the bank. Laying this groundwork is absolutely crucial for keeping investing from becoming a stressful experience. So, with that foundation laid, we hit the most common beginner question in Section 4. Where should beginners actually invest? Let's explore your options.
The guide breaks down 2 main paths here, mostly depending on your appetite for research. On one hand, you can utilize diversified funds, like index funds or ETFs, which spread your risk across many companies instantly. It's kind of like buying a massive basket, holding a little piece of the whole economy. On the other hand, there are individual stocks. That means buying single companies that you deeply research and understand. Neutrally speaking, diversified funds offer broader safety, while individual stocks require a lot more personal knowledge and time. Neither is wrong, but they offer vastly different risk profiles.
Let's move to and see how this builds into Section 5, Common mistakes to avoid: setting up guardrails for new investors.
The guide vigorously warns against 3 major traps so you protect your hard-earned money. First, the illusion of getting rich overnight. If someone is out there guaranteeing profits and fast wealth, just walk away. No way that ends well. Second, investing based on social media hype. Following the herd online and buying a trending ticker symbol is not fundamental analysis, folks. And third, letting emotions and headlines control your decisions. The market naturally goes up and down. If you panic sell over every scary headline you read, you literally just lock in your losses.
Which brings us to the final chapter of our roadmap, Section 6, a simple winning strategy for long-term success. So the crucial point is just to keep it simple. Master the basics, create a strict budget, invest consistently, even if it's just a little bit at a time, diversify to protect your capital, and continue learning as you go. Remember, success isn't about making one perfect lottery-winning stock pick. It's a series of smart, quiet decisions made consistently over a long period of time.
And that reinforces the ultimate truth of Noor's guide. Building wealth doesn't happen overnight. It happens through patience, discipline, and consistency. You don't need to be some Wall Street insider or have a massive salary to pull this off. You just need to commit to your long-term goals, dodge those emotional traps we talked about, and let compound growth do all the heavy lifting. That commitment is the true driver of financial freedom.
Which leaves us with one final, provocative thought to wrap up this explainer. Your money is waiting to grow right now. So, will you leave it stagnant under the mattress, or will you put it to work today? Every single day you wait is a day of compound growth left on the table. So go take a look at your budget today, lay down that responsible foundation, and take control of your financial future.